Warren Buffett is worth over $130 billion. He's spent 70 years mastering the stock market. But here's what might surprise you. His retirement advice isn't complicated. In fact, it's so simple, most people ignore it. Today, I'm breaking down exactly how the Oracle of Omaha would build a stress-free retirement portfolio and why his strategy might be the opposite of what your financial advisor is telling you. In his 2013 letter to shareholders, Buffett did something extraordinary. He revealed the exact instructions in his will for his wife's inheritance. Are you ready for this complexity? Put 90% in an S&P 500 index fund and 10% in short-term government bonds. That's it. No hedge funds, no real estate trusts, no complicated rebalancing strategies. The world's greatest investor is telling his own family to do the exact opposite of what Wall Street pushes. Why? Because Buffett understands something most people miss. Complexity is the enemy of execution. The more complicated your portfolio, the more decisions you have to make, and the more opportunities you have to mess it up. In retirement, you don't need excitement, you need sleep. Buffett's stress-free retirement strategy rests on three unshakable pillars. First, own American business. Buffett doesn't bet against America. When you buy an S&P 500 index fund, you're not gambling on individual stocks. You're buying a piece of the 500 largest, most profitable companies in America. Apple, Microsoft, Amazon, they're all in there. These companies have armies of the smartest people working to grow profits while you sleep. The S&P 500 has returned about 10% annually over the past century. That means if you invested $500,000 in retirement, historically you'd have about $50,000 in gains per year without lifting a finger. Second pillar, keep cash for peace of mind. That 10% in short-term bonds isn't about returns, it's about psychology. Buffett knows markets crash. They always have, and they always will. In 2008, the market dropped 37%. In 2020, it fell 34% in just 33 days. Here's the genius. When you have cash reserves, you don't panic sell at the bottom. You can cover your living expenses for a year or two without touching your stocks during a downturn. This isn't just smart. It's the difference between retiring comfortably and running out of money. Third pillar, do nothing. This is the hardest part. Buffett's favorite holding period is forever. The financial industry makes billions by convincing you to do something, to trade, to react. But every time you sell in a panic or chase the hot stock, you're probably hurting your returns. From 2000 to 2020, the S&P 500 returned 7.5% annually, but the average investor only 2.9%. Why? Because they bought high, sold low, and kept moving money around. The market rewards patience, not activity. Let's make this concrete. Here's how you'd actually build this portfolio today. For your 90% stock allocation, choose a low-cost S&P 500 index fund. Vanguard's VOO has an expense ratio of just 0.03%. That means for every $10,000 invested, you pay only $3 per year. Fidelity and Schwab offer similar options. For your 10% bonds, look at short-term treasury funds or even a high-yield savings account. Right now, these are paying around 4 to 5%, which is actually quite good. Let's say you have $800,000 saved for retirement. Put $720,000 in the S&P 500 fund and $80,000 in bonds or cash. If you need $40,000 per year to live on, that bond allocation covers you for 2 years if the market crashes tomorrow. Now, here's what you do next. Almost nothing. Once a year, maybe on your birthday, check if your allocation has drifted. If stocks did really well and now represent 95% instead of 90%, sell a bit and move it to bonds. That's called rebalancing, and once a year is plenty. I know what you're thinking. What about international stocks? What about gold? What about crypto? Buffett's answer would be simple. Those things add complexity without proportionally reducing risk. International stocks are already represented because S&P 500 companies do business globally. Gold doesn't produce anything. And crypto? Buffett called it rat poison squared. But what if the market crashes right after I retire? This is called sequence of returns risk, and it's real. That's exactly why you have that cash cushion. If the market drops 30% in your first year of retirement, you live off your bones and cash. You don't sell stocks at a loss. History shows markets always recover. The S&P 500 has never failed to reach new highs after a crash, ever. What about inflation? Stocks are an inflation hedge. Companies raise prices, their earnings grow, your investment grows. Bonds and cash are your short-term stability, stocks are your long-term protection. Warren Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." Building a stress-free retirement portfolio isn't about finding the secret formula or beating the market. It's about owning great businesses, keeping some cash for emergencies, and having the discipline to do nothing when everyone else is panicking. 90% stocks, 10% bonds, rebalance once a year, and get on with your life. That's how the world's greatest investor would do it. And if it's good enough for Warren Buffett's family, maybe it's good enough for yours. The question isn't whether this strategy works. History has already answered that. The question is, do you have the discipline to follow it?